Welcome everyone, and many thanks for joining us at this webinar on stress testing defaults, what happens to pensions auto-enrolment during a crisis. I expect we're all thinking, hopefully we won't be doing sessions like this for too much longer, but it's going to be interesting to see how this changes. But for the time being, we're still on our cameras. And this afternoon, we're going to be taking you through some recent research, which we just put out today from Nest Insight and our collaborators at the University of Nottingham and the Warwick Business School. And this is data-driven research, which is looking at the effects of the COVID-19 pandemic on the nearly 10 million, largely low to middle income UK workers who save in Nest. And as I mentioned, we've put this research out today. It's published on our website, nestinsight.org.uk. You can read a somewhat more detailed account of the results there following the session. But hopefully during the session, we'll be able to give you some of the highlights and also touch on some of what we think are the broader implications of what the research is telling us. I'm going to kick off by spending a few minutes setting the context for this research and why we've done it and what we think it shows. And then I'm going to be handing over to our excellent speakers. To my far left, as I look at myself on screen, it may be different for you. We have Jessel Sheth, who's a postdoctoral researcher in behavioural economics at the University of Nottingham. And Jessel is currently seconded into the Nest Insight team and was one of the lead researchers on this project. And next to her is John Gathergood, who's Professor of Economics and Associate Vice Chancellor at the University of Nottingham as well. And his research focuses mainly on understanding consumer behaviour in financial markets. And I'm going to be letting them do the bulk of the work here because they've been very heavily involved in making this research happen. But before I hand over to Jessel and John, I just wanted to give a few words of context. Because those of you who've been following Nest Insight's work for a while will know that quite naturally we started out when we formed Nest Insight by looking at how the retirement saving systems works for the predominantly low to middle income people saving in Nest. But very quickly we broadened that focus to consider the wider financial well-being of this group of people. And that's for a very good reason, because for people on lower incomes, it's obviously important to think not just about their pension savings in isolation, but to understand questions about how much money they might be able to defer for retirement alongside their broader financial needs. And if you want an example of this kind of holistic approach that we're now trying to take, you may well know about our sidecar savings trial that's running at the moment, and that's a very good example of how we're trying to think about short and long term really married together. And so given this focus, quite naturally, when the COVID-19 pandemic hit and last year, and when the government measures started to come into place and we started to understand what a severe disruption this was going to be to the working economy, we knew that would have to have a profound effect on our research and on this whole question about short versus long term in people's financial lives. And as you all know, I'm sure there's been a wealth of high quality research understanding what the impacts of the pandemic have been on workers and on incomes. So you might ask, well, what can a research unit based at a large government-backed pension scheme add to this kind of body of knowledge? And hopefully the reports that we've been putting out recently, many of which have touched on these impacts, sort of start to answer that question. But today's a bit different. Today, for the first time, we're going to use Nest's data, this very large data set that we're custodians of, to do a deep dive into that past 14-month period and pull out what we think are some new and interesting insights. And those insights, as well as giving what we hope is a very granular view of how people's retirement savings behaviours have changed during the pandemic, they can also actually give us quite a deep and rich picture of how people's incomes have been affected as well. And this is really the point I'd like to leave with before I hand over to our speakers, which is this work that we're about to share, I think, illustrates the tremendous research value of the data that we hold in Nest, which we're really only starting to explore in this study. Because these data come to us from hundreds of thousands of employers. They represent data on millions of UK workers, and they contain really quite important data, not just people's pension activities, but also their earnings and moving very often in and out of jobs as well. And as you'll see, particularly from Jasel's presentation, that this can really help us pinpoint labour market effects really in quite a granular way between different groups of workers affected at different times by something like what we've all experienced in the last year or so. And hopefully sometimes get under some of the headline statistics and get a bit more detail on those and understand really quite specific effects. But that's enough from me. I just wanted really to give that as a bit of context. And also, before I hand over to our speakers, I just did want to thank, first of all, the whole Nest Insight team, for making this webinar and this research possible, but particularly to thank our collaborators at the University of Nottingham, two of whom you're about to hear present, and also at the Warwick Business School, where I should particularly mention Neil Stewart and Chris Firth. Chris particularly has been very heavily involved working with Jessel on the analysis, so thank you to both of them as well. And I should also thank the organisations whose funding has made the work possible. In particular, there's a COVID-19 Rapid Response Grant from UK Research and Innovation, and alongside that, the ongoing support to Nest Insight provided by BlackRock, the Money and Pension Service, and JP Morgan Chase, all of whom support our wider programme of research into emergency savings and debt. So thank you to all of them. So in a moment, I'll hand over to our presenters. First, Jessel will present the findings of the research, and then John will reflect on what these results tell us and some of the questions that they raise. And then we'll come back to you for any questions that you might have. So while you're listening to the presentations, please do submit any questions using the Q&A function that you should be able to find on your screens. We'll try and get to as many questions as we can, but if we don't get to yours, please do feel free to get in touch with us using the contact details on the Nest Insight website. And if you want, as I said before, if you want to comment more widely, please do use the financial resilience hashtag for your comments. But without further ado, I'm now going to hand over to Jessel for your comments.
Thank you, Matthew, for that very helpful context. And yeah, so and thank you to the audience for attending today's webinar. Today, can you see my screen? Yeah, perfect. Okay. So today I want to talk about the economic impact of the pandemic on the members of the Nest pension scheme. And this strand of work has very much been a team effort with my colleagues at Nest and the universities of Nottingham and Warwick. So since the initial shock of the pandemic, we've been exploring what the crisis means for people saving in Nest, who typically tend to be on low to moderate incomes. And how could we contribute to a better understanding of the challenges facing low to moderate income savers during the pandemic? And to investigate these questions, we use Nest data, which provides an extremely valuable source of insight into the economic impact of the pandemic. And this is because Nest data is one of the few sources of large-scale real-time information on a variety of indicators that pertain to an individual's financial life. The Nest data covers over 9 million workers across nearly 900,000 UK employers, and a large proportion of Nest membership comprises low to moderate income workers. So using this data on Nest members, we've analyzed the impact of the COVID crisis on three things. One, the growth in pensionable pay, on self-reported perceptions of financial well-being, and on broader voluntary retirement saving behaviors, such as opt-outs, cessations, and withdrawals. So in the next few slides, I will summarize the results from our analysis, which we've also published as a series of blogs earlier today. So first, I will talk about the impact on growth in pensionable pay. So what we have done here is we have calculated the growth in pensionable pay in a given month relative to the previous year for each member in our sample. And we've looked at the distributions of these growth rates across members. Now, this is what is plotted here. What you see is it's broken down by industries. Now, for example, if you take the middle column here, the growth in pensionable pay is plotted for members that work in sectors in retail, wholesale, and hospitality. Now, for example, if you look at the month of Jan 2020, we see that the median growth was positive, which means that over 50% of the members in our sample experienced an increase in their pensionable pay. But there's also a significant proportion that saw a decrease in their pensionable pay relative to the previous year. For instance, the lowest quartile of people, which is indicated in dark green here, saw a decrease in pay by 2 or more %. Now, from this analysis, we find that pensionable pay growth has varied quite substantially over the course of the pandemic and across sectors as well. And in particular, retail, wholesale, and hospitality and manufacturing, especially in the first lockdown, saw some very large decreases in pay, which is here and here, which wasn't the case so much for the professional services sector. Now, in contrast, the second national lockdown in November 2020 mainly affected retail, wholesale, and hospitality here, whereas the pensionable pay growth in manufacturing across the distribution seems to have improved relative to the first lockdown. Now, all of this would have been masked by aggregate analysis of such data. What we also know is women and young people are overrepresented in sectors that are most affected by the lockdown measures. And so these groups seem to have been disproportionately affected. Now, next, we've looked at how household income and self-reported perceptions of financial well-being have changed across the different groups as a result of the pandemic. And for this, we have used data from November 2019 and November 2020 surveys that was conducted with a sample of NEST members. Now, we find that the self-employed, the unemployed, and those that were unable to work due to sickness were significantly more likely to report that the pandemic has had a negative impact on their household incomes relative to those in full-time or part-time employment. Now, this reported decrease in household income by the self-employed also seems to be affected or reflected in lower levels of satisfaction with financial situation. What we also find interestingly is that the importance of saving for an emergency increased in 2020 relative to the 2019 wave. And so we saw quite a few changes in pensionable pay and perceptions of financial well-being. So we next wanted to investigate whether these changes translated into changes in voluntary retirement saving behaviors like opt-outs, cessations, and withdrawals. So we looked at these indicators or these behaviors across months and across different groups. And what we find is that the pension saving behaviors relating to opt-out, cessations, and withdrawals have not changed substantially during the pandemic. And we see that although there was a slight increase in opt-outs to about 12 to 13% during the first national lockdown, the opt-out rate seems to have dropped back to 2019-2020 levels of an average of about 10%. So in general, opt-outs tend to increase with age, and this relationship holds across the time period we considered. But the biggest change in opt-outs was among those aged mid-30s to about mid-50s, whilst younger and older employees showed little to no change in behavior. Now, this slight increase in opt-outs also seems to have been driven by firms with fewer than about 250 employees. And behaviors with in relation to opt-outs or cessation, in relation to withdrawals and cessations don't seem to have shown a substantial change. So what does all this analysis tell us? The broader picture story here is that the economic crisis that has been fueled by the pandemic has had quite large distributional impacts on pensionable pay growth across individuals, on people's satisfaction levels with their financial situation. But we don't see substantial changes in retirement saving behaviors as a result of these changes, which sort of makes us question whether the calmness that we see in pensions behaviors is being accompanied by changes in other aspects of an individual's financial life. And I will leave you with that question and hand it back over to Matthew. And thank you all for listening.
Many thanks, Jessica. That was very impressive the way you got through really quite a lot of material in a very short space of time, and so clearly, I think, told the story as well. As I've mentioned already, for anyone who's watching, who's keen to drill down into more of the detail of what the results told us, we have got a much longer set of reports in the blog posts that Jessica mentioned, which are on our website at nestinsight.org.uk. But as I said, we're keen to try to look at what the broader ramifications and questions are that are raised by these initial set of findings on the first part of the COVID crisis. And so I'm now going to hand over to John, who will speak a little bit to that.
Brilliant. Thanks ever so much, Matthew, and thanks, Jessica. And as I speak to these points, in anticipation of some discussion, attendees might have some questions that you might want to throw up for discussion. I'll speak a little bit about the broad implications of the research that we've done to date, and then the direction of future research. Because I think what we see in the research that Jessica's presented, and the fuller version is on the blog, as Matthew has mentioned, is that we're seeing the effects of the pandemic in the Nest membership, but we're not seeing the effects of the pandemic in the behaviours of Nest members. So, for example, on those pensionable pay plots, you could see how the way in which the pandemic has translated into reduced incomes, even in the existence of the furlough scheme, is playing out across different sectors and affecting different age groups and by gender differentially, as we see broadly in the economy. But what we're not seeing is that affecting the choices of Nest members on issues such as opt-outs and withdrawals, or when we look at their portfolio decisions about how they invest. Now, what that means for retirement saving is, of course, there's less saving going on because pensionable pay is reduced, but there isn't less saving going on because people are choosing to adjust their saving behaviours. So that shows that the scheme is really quite resilient through a period of remarkable volatility, both in people's incomes and in financial markets. If we think back to around a year ago when financial markets were exceptionally volatile, one saw a lot of retail investors jumping out of the market, jumping back into the market around the end of March, April time, but we don't see that happening in the Nest membership. And so that does give a strong impression that there's resilience in the system. I think one of the questions that actually leads on to is whether auto enrolment in some way might be working too well. That is, in a period where individuals and households might be under stress in their personal finances, are they continuing to save even though that saving is taking liquidity away from them that could be important for other means? And that is a question that we're examining in the broader set of research questions that actually started pre-pandemic but have come even more into vogue during the pandemic. Because in this project more broadly, what we are doing is linking up retirement saving data with other forms of data, such as data on credit and debt, to understand when individuals experience auto enrolment into the pension scheme, how does that affect the rest of their portfolio? What does it do to their, for example, borrowing behaviors, or what does it do to the way in which they pay their household bills, which we can see in other data sources? And then during the pandemic, when individuals are potentially under a lot of stress in those other areas, their finances, do they pause their retirement saving or do they not pause their retirement saving? And that's again where sidecar savings may be very important issues for ensuring that individuals have liquidity for those short-term shocks, as well as having long-term saving, most obviously for retirement. And that's where joining up data is allowing us to address a broader suite of questions. So the research questions that we were thinking about pre-pandemic seem to be all the more important now that we're going through this period of the pandemic experience. I think the other thing that I would say about the research that we're doing here is that we've been through a year of extensive government support, as everyone knows, both in terms of supporting incomes of workers, but also support through consumer credit temporary relief order, reducing the burdens on households to have to pay their mortgage, to have to pay consumer credit payments. There's considerable forbearance among utility companies and others that require bills off individuals. Now, as we enter what we might think of as a post-pandemic period, we may see upswing in the labour market quite radically, as the Bank of England is projecting, but we'll also see much of that support being withdrawn both in terms of the support for households' incomes and the support around their obligations and their repayments. And so then we might see some of the other effects of the pandemic, the longer term effects, playing out. And we might see that happening as well in the Nest membership. And an advantage of having these monthly data that are updated really quite frequently, and which we can draw on quite quickly, is that we can see these patterns emerge in close to real time, and therefore provide some input to policymakers and to other groups that are interested in really understanding how the pandemic is continuing to play out as we emerge into the next phase. Thanks, Matthew.
Thanks so much, John. Yeah, that's an incredibly helpful set of points, which I think really sort of throws the very specific results we found here into a much broader context. I mean, I might just before we move on to some questions and answers, I might just sort of make my own reflection on a couple of the points you made, which is one of the things that I was really expecting to see when we first set out to explore this data during the pandemic period was that when people reach the age of 55, which within the UK system, I'm sure everyone will be aware, is the point at which your pension pot in the DC system moves from being a completely illiquid vehicle that is purely there for the long term, you can't touch, suddenly overnight on your 55th birthday flips into being effectively a fully liquid vehicle with only some very limited tax penalties and savings limit penalties coming along with that. Given that we knew, and we can see in these data, that an awful lot of people might be experiencing some challenges in their liquidity and maybe having to draw on debt and other sources of financing, as John's mentioned, it seemed very natural to us that the pots that people have built up in Nest, which because people have only been saving in Nest only a few years, do tend to be relatively small. And for older people, there might well be other retirement assets in the household. It seemed really natural that that would be a pot that people might draw on. And the fact that we haven't seen any change in terms of withdrawals at that inflection point where it moves from fully illiquid to fully liquid is really quite striking. And I think, you know, it's very often you look at results that say no news, and it just seems like that's no news. But actually, I think it's really worth just pausing and reflecting on what a striking finding that is. And we do know when we look at other systems, for instance, in the United States and Australia, where there might be more liquidity at different stages of the process and where the systems are a lot more mature, the DC systems are a lot more mature, we do know there has been a lot more behaviour. So it may well be that this is a property of where we are in terms of the automatic enrolment experience in the UK. And as John says, we need to take that study forward a lot more. But it is really striking that we're seeing quite such a flat line in terms of what the behaviours have been during this time. Now, I'm not seeing any audience questions come up in my box here, which either means the two presenters have been so incredibly clear that people don't feel they've got any more questions to answer, or it might be because they're not coming up. Oh no, here we are. They've started to come up. That's great. My colleagues behind the scenes have pressed a button. But before I move on to those questions, I might just throw a couple of my own at both of you. Starting with you, Jessel. I mean, one thing that I said and you said at the beginning is that perhaps surprisingly the Nest data set is a pension data set, so you might expect it to have a relatively limited application in this kind of research. But because of all this pay data and so on that we're receiving, as you pointed out, there's an awful lot that we can do with these data that we might not have expected to be able to do. But it's probably worth saying as well that there are some challenges and limitations in working with these data. And it'd just be interesting to hear your observations on some of the things we tried to dig into. I mean, for instance, around the furlough program, and yet which the data didn't quite reveal, and what that tells us about the data we're working with.
Right. Thanks, Matthew. That's an interesting question. So I guess I'll first talk about like the broader limitations with large data sets in general, which probably apply to a large extent to the Nest data set, and then delve into some of the issues we came up with, which are perhaps more specific to Nest. So in terms of like the limitations of generally working with large data sets is, first of all, I think it's to do with the data structure. So many large data sets can be used to answer multiple questions, and administrative data sets like Nest aren't usually collected with the intention of being analyzed in the way we use it for analysis. For example, they come in different sort of bits of reports and files at different levels or units of observations. So these files and observations need to sort of be standardized and converted into structures, or as John calls it, data assets that can be used for analytical purposes. And to be able to do this, you often need like a mix of very efficient coding, like my colleague Chris does, and a lot of industry-specific and analytical knowledge. But more often with such large data sets, you often face like computational and processing power limitations, even if you make the code as efficient as possible. And so you need to often make these decisions about how to sample appropriately for analysis. And by appropriate, I mean in the way the sample is random and ideally representative of the population that you wish to generalize your results to. So by all this, what I'm trying to say is that there are some issues that are very specific to NEST as well, which is how do you deal with some missing information that perhaps employers may not have reported on certain groups of employees. And the usual way you would go about doing such filling gaps with some missing information is to just impute it. But in cases where we work with data that is volatile because, for example, of the nature of jobs or the groups of people you're dealing with, you often can't impute it in a very sensible manner or without making assumptions that can be questionable given the group of people you're working with. So from an analytical perspective, we'd often need to make some judgments and to basically account for potential biases, but also caveat these biases to make the wider public or the consumers, if you're a research, aware that this is again a subset of people, but it can still be valuable in terms of deriving some valuable insights to inform future policy.
Thank you, Jesse. Yeah, I think that's a really helpful way of framing the challenge. And certainly, I think it's very easy to think about people's earnings in the economy as being in a sort of nice steady line, and then something like the furlough program comes along and you sort of drop by exactly 20%, and then you get a nice steady line. And certainly, our experience in NEST is 60 or 70% of our membership experience really quite significant earnings fluctuations week on week or month on month. And that does, from research we've seen elsewhere, that does seem to reflect the economy as a whole. So this stuff isn't maybe as straightforward as it sometimes might look. John, I just wanted to pick you up as well on one of the points you were making about the need to think about not only what's happening in the automatic enrolment system, but elsewhere in people's financial lives. And you've obviously got a lot of experience working with quite a range of data sets from different private and public sector sources, and trying to use those to think about people's whole personal finance perspective. How do you go about trying to draw some of those conclusions about how one part of the savings economy might be reflected in another part of people's experience of the financial system?
Yeah, absolutely. So I think that we're making a lot of progress in the UK in first being able to put ourselves in a position to draw those kind of inferences. So in some of our comparable nations in Europe, they're already further along the line in, I would say, joining up data so that you can see multiple dimensions of the individual's life in a single data set. So particularly in many Northern European countries, you might even have health records and education records and financial records joined together. So you can get a really, really complete view of an individual's life. We're not quite there, but I think that we're moving forward, and things like GDPR and the Digital Economy Act actually help us to define the purposes and put us in a safe framework for being able to do this. And so in the work of organizations like the Financial Conduct Authority and the Competition and Markets Authority, and then also in work done out of universities, we're increasingly seeing data sets joined up, and there's some great industry collaborators who have a lot of expertise in making those joins to facilitate that kind of research. And then to make scientific statements about the effects of policies, say such sort of enrollment on individuals' financial lives, one is really looking for a scientific quality type of experiment. That might be a randomized control trial in the data. It might be a way in which a policy has been introduced that facilitates experimental analyses. It might be an event that one can exploit as what we would call a natural experiment. That's where an experiment arises, maybe even though it wasn't designed to be an experiment, so that we can make some compelling causal statements. And again, if you look at some of the work of the Financial Conduct Authority, and the FCA is engaged in field trials, it's also engaged in some of these natural experiments and the work that it's done on topics such as credit card repayment and payday lending. And so we're in an increasingly strong position to be able to conduct these types of analysis. And I think the key issue here is that when we're doing these types of analysis, what we're able to do is improve our understanding of policy design, and regulation. The types of data that's being joined up isn't being joined up for the purpose of consumer marketing or in some sense feeding back implications for individuals. These analyses are aggregated to allow us to make general statements at the economy-wide level or at the group level about how these policies are affecting people's lives. And that's something we're going to see, I think, increasingly across the scope of activity done in government and policy, and also in industry in coming years.
Thank you. Yeah, that's a really exciting prospect. And inevitably, I'm just looking through the questions that people have raised in the audience. Inevitably, you present back some findings from the data, and it answers loads of important questions and raises many more. And there's some really good ones coming through. So I might just throw some of these at you and see what either of you feel. Sort of picking up a little bit on what you were just saying about sort of looking at the wider data landscape, John. A question we've got here is, how do you think NEST members differ from the general population, and how might that affect what we're seeing in these findings?
Jessa, would you like to say something maybe first out of the analyses?
Yeah, sure. So in terms of how representative this analysis is of the wider population, I think it's a good point, because as I mentioned earlier, NEST members tend to be typically on low to moderate incomes. So in that respect, it might be a bit of a question to see what behaviors have been towards the other end of the spectrum for those who are between moderate to high income earners. Yeah, I mean, we haven't done specific subgroup analysis in terms of income groups, but one thing that we did pull out is regarding perceptions of people around their financial well-being in the second or the third blog post that we published. And we do find that those that are high income earners tend to be a lot more a lot less financially dissatisfied with their financial situation compared to low income earners or middle income earners. And in terms of like demographic like representation in the NEST sample, what we do find is that the share of women and young people in the wider sector, the share of these demographics in different sectors is quite representative of the wider stats we see from, for example, from the labor force survey. So in that sense, you can generalize, but you also got to be very cautious about it.
I think just to make a sort of general comment, I think there's a general tendency, and we feed it by talking about low to middle income people. There's a tendency to think of the NEST population as sort of towards the bottom of the income distribution and age group, but actually the size of the population is so large that we do get representation right across the piece. It's just it's weighted in that sort of direction. So I think that's right, Jason. I mean, when you look, for instance, at the results for the sort of professional sectors that were on your left-hand set of charts, and where you see the very different income effects, you can see the diversity of experiences that people have. And this leads me to another question actually that we've had, which is one of the things visible in the blog post is that there are lots of new accidental savers. This is people who have found that they're building up balances because their costs have gone down during the pandemic, travel and so on, but their income hasn't. The question is, should we and how could we encourage this group to make voluntary contributions to their pension? And I think I might just sort of add another sort of part to that question is sort of there's the question of how can we capitalize on accidental saving to create opportunities to get people saving. I think there's also the question of how you can encourage people who might have had a negative experience during the pandemic and didn't have any reserves, how you might encourage them to start generating some more liquid savings as well on top of the retirement saving that they're doing. John, is that something you might want to tackle? Quite a broad question.
Yeah, I think there's quite a lot of evidence that there are indeed many accidental savers. So if you look at the retail banks reporting just on the balances that they see sitting in people's debit accounts, these are looking very, very healthy at the moment. Indeed, I think we've seen, certainly documented in the US, but also cases in the UK, where there's almost a kind of splurge of retail investing going on among individuals who may have found that they have kind of excess balances, partly again due to the government support of income and due to the inability to spend. I think the big challenge is how that translates to long-term saving, because long-term saving tends, over the course of an individual's lifetime, the increases that we've seen in spare cash during the pandemic might be relatively modest. I think I'd be surprised if this can have big effects on long-term saving, but I think that there's probably more scope to try to have an effect on short-term savings behaviours. It's really going to depend on what people's expectations are for what happens post-pandemic, and if individuals are precautionary in their view of what happens this summer, this autumn, going into next year, you might see people preserving these balances for the just-in-case scenarios. If we have a very strong indication that the world is going to go back to some kind of new normal, which is much more open and post-COVID, to some extent, if you look at the comments from the Bank of England and Andy Hadley's comments just today on the speed of recovery, you may see people pay down those balances quite quickly, and I think it's difficult to change that behaviour. There are lots of quite generous options for individuals to make use of excess savings that they might have, be it through the long-term savings vehicles that we have in the UK, including private pensions, be it through things like ISAs or leases, which are now very liquid, as well as being extremely generous in their tax match. But I think a lot will depend on people's expectations for what they see happening over the next 1 to 2 years.
Yeah, and sorry, just to add to that, I think we as an industry will probably have to do a lot more in trying to encourage longer term retirement savings. Also, there's some evidence in the Bank of England monetary policy report as of this month that where they conducted a survey and asked how people are planning to what are they planning to do with the savings they've accumulated over these months, and increasing pension contributions is probably one of the last two categories that come up as most frequently cited. So most of them tend to say they'll hold it in their bank account, they'll spend it over the months, or either they'll pay down their debt, which is still a good thing, but we'd probably have to push a bit more to increase pension savings.
Thank you both. Yeah, really fascinating. And I think that really speaks to the points we've been making about the need to think holistically about all the different parts of the financial system here. And I'm seeing that quite a number of the questions are coming through that are sort of touching on similar themes. Might just sort of pull out one here, which is given the change in household finances that we've seen, well, at least certainly self-reported in the survey data, what do we think is behind the lack of pensions withdrawal behaviour? Is it inertia caused by the disconnection or lack of ownership people feel with their pensions, especially in auto-enrolment maybe, or is it more down to the frictions inbuilt or in the system or perceived around making withdrawals from pensions? Is this friction? Is this inertia? Is this will? And do we have any way really of unpicking what the drivers are of these sorts of behaviour?
I think this is one of the questions that we want to understand. And if I had to take a moderately informed guess, I would say there's a lot of inertia in individual decision making. But one of the things that we're very keen to understand by joining Nest member records with information on credit and debt is indeed whether individuals are finding themselves short of liquidity. So what I mean by that is maybe, delinquent on a credit card, behind on a mortgage, behind on a council tax payment, and yet are continuing to make pension contributions, which they could opt out of. I think that will help us to understand a lot about whether individuals are possibly ignorant of what's happening in their own finances, and therefore the friction is on the individual's part, or whether there's not been a need to access this liquidity during the period of the pandemic. And so I hope that we're going to be able to say something more substantial on that. We do see generally relatively low levels of engagement. So low levels of engagement in terms of portfolio balancing behavior and changing investment decisions, or logging into online accounts to view what's going on, which kind of indicates that maybe there's inertia on the part of the member, which is maybe a major driver of inaction here.
Great, thank you. And we are coming up to the end of our time. Only got a couple of minutes left, but I think I might just try and squeeze in one more question, if I may. And this is really to try and take the focus forward to the future and what we might do next. I've had a couple of questions that have asked in different ways whether we expect to see change coming later on. And John, you touched on this a little bit in your comments, but given that the economy is opening back up, the job retention scheme is going to be phased out over the course of the summer. What would be our big predictions of what we expect to see coming when we next look at these data later in the year, and also if you want to comment on how we're planning to return to these analyses later in the year, that might be a good way of framing that. Either of you, really.
Do you want to go first, John?
No, do.
Okay.
Feel free to start.
Okay, this is a really good question, and it's left us pondering a bit over this as well. Again, I think in Feb and March, we have seen some signs of recovery in the labor market. There's been an uptick in the number of vacancies, for example, which is a good indicator of labor demand. We've seen employments furloughed after Feb on a declining trend, which all seems to suggest that there's hope, there's ray of hope for positive uptick in the economy. But at the same time, we'd have to see how things fare when the government support schemes wind down towards the latter part of this year. And on that front, I don't think I at least would want to go ahead and comment on what we might see, and maybe John's better placed there.
Well, I can take a stab. I think that what we saw in the declines in pensionable pay, we'll probably see some of that reversed, not principally due to pay growth in hourly pay, but due to the fact that Nest members often experience variable hours or variable numbers of employments. And so I'd imagine, especially in those hospitality and recreation sectors, as we go through the remainder of this year, we'll see increased hours, but also Nest members holding more employments as they pick up second and third jobs as more hospitality venues reopen. And so I'd expect to see quite strong pay growth, and that will of course feed through to higher contributions. I wouldn't expect to see much change in those behaviours, because those behaviours have been resilient even during a period of big pandemic and quite big stock market crash by the last 30-year standards. And then in a period of growth and recovery, I don't see any reason why people will start opting out or adjusting their portfolios any faster than in the time of decline. So I think we can see how some of the data is likely to move over the next few months to the remainder of this year.
Mm-hmm.
Thank you both. Well, that feels like an excellent way to leave this, and with a nice trailer there, I think, implied to the fact that we will be definitely repeating this analysis later in the year, probably in the late summer, early autumn, when we really expect that we might start to see the beginnings of some of these new trends coming through. We very much look forward to sharing those results with everyone at the time. But for now, many thanks for attending, to everyone who did. And as I say, if you're interested in finding out any more about the research, do have a look on our website where the results are published, and also drop us a line using the contact details on the website if you want to find out more. But for now, thank you very much. We'll sit here for a while and watch you all leave and do that thing where we look embarrassingly towards our cameras. So please do just sort of turn off your own connections whenever you wish. Goodbye and thank you.